Oh, we recording? Hi guys, this is Mr. Stay Fresh, so I don't have to get fresh. Host of the H.U.S.H podcast, Ron, asking everyone, please like, subscribe, and share it to all our major platforms. It'd be truly appreciated. Thanks. There's only but a few at the bottom we can follow. Who possesses the will to win? Stay 10 toes down, even when the stream begins to thin. What does that actually look like? Hush money. Help us save humanity. Money over negative entities, you dig? Now come join in on this conversation I'm about to have with Tasha here in this shared space of respect and gratitude. Thanks for coming.
You're welcome.
To voice your honest opinions, because they do matter, so does growth, with the ability to agree to disagree. Hush Money welcomes you.
Thank you.
Well, how you doing?
I'm good. How are you?
Man, I'm fine. I'm glad you finally got a chance to come.
Yes.
And I know that we got plenty to talk about. So I am going to let you get the floor because, you know, and what I want to start with is insurance.
Okay.
I'm talking about housing, though. And then we can get into real estate.
Okay.
Housing is important to why to have, you know, insurance for where you, even if you rent in, the importance of it. And then let's talk about real estate and what it is that we should know and the questions that we should ask to try to get the better loans or programs we don't know nothing about.
Right. Okay.
The floor is yours.
So, hi, I'm Tasha Johnson. My name is Natashia, but I go by Tasha, and I am your local real estate and life insurance agent. So, to answer some of the questions that they call you Ron is wanting to know, and for the people out there. So basically, I'm going to talk about life insurance. Life insurance is what I sell. Mm-hmm. I don't do Medicare. I don't do any of that stuff, but just life insurance. Mm-hmm. So we're going to talk about life insurance in general and why it is important to have life insurance. Now, on the rental side, that part, I don't deal with the rental insurance, but I do have people for mortgage lending, if that makes sense. We'll talk about that here in a minute. So life insurance is very important because we all know that we're not guaranteed. We're not here for a long time. And with me just having a loss, even though, you know, my father passed away last year, I hope you don't mind I talk about that, but my father passed away last year, February 5th of last year, of heart disease is what they said that he had. Luckily, he was set. Luckily, he had life insurance in place. Life insurance is very, very important because when things like this happens, you want to be set. You want your family to be okay. You don't want your family trying to figure out where they're going to, you know, get the funds up to have a proper burial, you know, pay bills or whatever. So, that was the whole reason that I got into life insurance because, you know, it's about caring about people, getting people to understand, you know, the importance of it. So we're going to talk, the first product that we're going to talk about, and when I talk about the products, I want to tell you guys the products that I do sell.
Not to cut you off.
Mm-hmm.
Okay. You on life insurance?
Yeah.
You do real estate too, right?
Right, but I'm going to talk about that in a minute.
Yeah. But the reason why is because life insurance is very important, right?
Mm-hmm. It's very important.
That's why I wanted to say that for the next one.
Okay.
You know what I mean? And the reason why the housing market to go first is because it's important.
So you want me to talk about real estate?
I want you to go to knock out the real estate part of what it is that you do, right?
Okay.
Because I want to really get in depth with the life insurance.
Gotcha.
You know what I mean?
Yeah.
Okay, that's all I was just.
Okay, so he wants to talk about real estate first. Okay, so licensed realtor since 2021. Okay, we all know that during COVID and even some parts of last year, we were in a seller's market. What that means, everyone, seller's market is that there was no inventory for buyers. So
explain. No inventory for buyers.
Inventory means that there was no housings for buyers. So buyers couldn't really buy anything because there was no inventory.
Okay.
So it made it a seller's market because now there's no inventory. Sellers have the opportunity. I can jack up my price and sell this house for X amount of dollars And now buyers are going to, and you had a lot of buyers that was desperate for a home that was actually paying top dollars. So let's just break it down. You got a property on the market for $300,000, okay? And you got all these different buyers coming in and they're looking for something to buy. So now they're competing. They're trying to figure out who's going to have the best bid for this $300,000 home. So what the seller did, the seller's going to jack the price up because now he's got this bidding war. He's got these people that's wanting to come in. They want to pay X amount of dollars. You had some people offering $20,000 for due diligence. Due diligence, guys, is not refundable. So when you're planning on putting that kind of money into a property that you may not get, just know that you won't get it back. So we was they were having due diligence like $20,000, $30,000, so forth and so forth. So
not to cut you off, but to cut you off. So due diligence is whenever they send somebody in to appraise the house. What's due diligence?
It's that too, but due diligence to a seller. Due diligence to a seller is for me to pay you X amount of dollars to take the property off the market. That's what the due diligence is. If your offer wins it, so you pay if you have a high enough a winning offer, you put your offer in. You give seller the X amount of dollars. I actually got a listing right now. You get a seller X amount of dollars to pull that property off the market.
So nobody else can bid on it.
Right.
Okay.
But
I just want everybody to understand what due diligence means.
And then it also means too for the buyer. It means for the buyer, once your offer is accepted, you have 14 to 21 days to do your due diligence, meaning that you have to go in. You don't have to, but I recommend all of my buyers to get a home inspection done. Reason being is because in the event that something happens and after you close, and if you don't have that inspection done, you just crap out of luck. Because now, because you did not have that inspection done, we done closed. We at the closing table. Everything's done. Boom, bam, your roof starts to leak. Which that is a material fact because if there is a water stain on the roof or anything that's going on, it's material fact and it needs to be disclosed. But what I'm saying to you is that your due diligence buyers, for my buyers out there, is very, very important because this is your time within your due diligence period, within your time frame, 14 to 21 days or however long you want it to be, to go in to inspect that property, find out anything that can be negotiated. If it cannot be negotiated, then that is your time to back out. Because if you do not do your due diligence, and everything is done and said and over with, there's nothing you can do. You're stuck with this home with a water leak. You stuck with this home with a hole in the wall that you didn't know. You stuck with this home
with electrical problems,
plumbing
problems,
and all that stuff.
Foundational problems.
Exactly.
No doubt. I just want to make sure that everybody has to understand what she's really putting out here. Really. You know, so it makes sense. So, and I'm gonna tell you my preference, but my preference. I love working with buyers because I love actually taking the buyer to the home, especially when they're under contract, and I love going with them to do their due diligence so we can find things we can negotiate. Because let me tell you, I just had a closing in December where I worked with this young couple. Okay. And because they listened to me, everything checked out. The house was built in 1940. Ooh. The owner went in and gutted it. Made it look beautiful. And he did everything himself. Okay. But I don't care if a builder done it. Get your inspection done because somewhere, somehow, there's something wrong. Right. And in the event, we did the due diligence. We did the inspection. Little few minor things that could be fixed. But it turned out that they thanked me later because they said that, by them getting the inspection done, they found out that there was a little bit of things wrong with the house, not too much, but it was things that can be fixed. Right. Those are the things that we're talking about. Right. And so, you want to know about the housing market? Yes, okay. Definitely. So, I did a stat analysis for Catawba County. Okay. because you can't just everybody don't know what a
A
stat
stat analysis. I just did a market analysis to
Okay.
see where the market's at in
Okay.
Catawba County,
Okay.
pretty
All
much.
right.
And so the information that I pulled up was that compared to 2014 and 2024, I'm sorry, to 2025. 2024, there was not many inventory. There's a lot of inventory now. Housing, you know, of course, have you seen where they building?
Yes.
They're building up like it doesn't matter Hickory, Newton, no matter where you go, they're building crazy. So right now, it's kind of like balancing out, you know, but it's slowly getting to a buyer's market.
So, what are the numbers like though now? Because you're right, during COVID, there was houses that wasn't worth nothing but 60,000. It was selling for 200,000.
Well, the housing. Okay, so last year, from what I did my data, last year I think the housing markets was like 300,000. When I did it for Catawba County, my memory serves me right. You know, it was like up to 400,000 now. Is what they're closing at. You know. Of $400,000 or whatever, but it just depends on the area you're in, you know. So I want to say one of the numbers was the days on market. Now the days that the property, so the general rule of thumb from what my coach tells me that a house shouldn't be on the market no longer than, I want to say, she said between 7 to 10 days, if my memory serves me right. And that is only because if the house is staged properly, if the comparables are done right, if and comparable means comps, meaning that you comp the property with other properties, you priced it right. That's what that means. Okay. And your staging look good, and this and that, curb appeal, all that stuff. When people see those things, when people see that you got a decent price for the house, it's not overpriced, because people can tell when a house is overly priced.
Oh yeah, definitely. Yeah.
And if it looks good, the yard looks good. I'm a type of person, I don't know about you, but when I'm riding past properties, the first thing I'm looking at is the yard.
Yeah.
The first thing I'm looking at.
That's one of the first things you see anyway.
I'm looking at the bushes, the trees, the shrubs around it, how it looks.
As maintenance.
When I go into a home, when I'm taking someone and going into them, I'm going to tell you the first two things I look at is the kitchen, because I love to cook.
Okay.
And then the bathroom.
Oh, yes, for sure.
The bathroom and the primary. We don't call it master bedrooms anymore. That just don't sound right. We say primary rooms now. Primary bedroom. All right. I look at those things. And then I look at the cabinets. If they need to be, I'm walking around, I'm looking at stuff, and if it don't catch my eye, I mean, I can't tell my buyers, hey, I wouldn't do this because I don't like this and I don't like that. Right. You can't do that. No, yeah. But if we come out and we're talking about the same exact stuff that we saw, then we know that this house is not for them. But just, I done got off track, and I do that a lot. But
that's okay though. You still on point.
What I'm saying is that the days on markets makes a difference. If a house is on the market for longer than those days that I just mentioned, there's a couple things that's wrong with it. It's either priced too high, and 9 times out of 10, it's priced too high, or there's something wrong with it. Okay. And buyers don't want to spend all that money trying to fix it. Right. Now, this is where your negotiation comes in at. Okay. So you got a house, and we're just gonna just throw a number out here, right. Ron. Yes. You got a house for $300,000. This is what you're asking for. And I come in, I have my home inspector, have my home inspector look at it, offers accepted, or maybe if I even put in an offer. The first thing when you get ready to put in an offer, you never want to go in and asking price. Yeah, of course not. You never. But see, I had a client that wanted, because they wanted the house so bad that they wanted to go in and ask the price. No, you don't do that. You leave room for negotiation. You leave that room because just in case you get this house, and if there's anything that need to be done that the sellers don't want to pay for, because mind you, sellers don't have to fix anything. They just have to disclose. They have to let you know what's going on. But they do not and are not required to fix anything. So, with that being said, you don't never want to go in offering the full amount. You want to go in with like $300,000. I'm going to say I'm offering $250,000. Now the negotiation comes in. You counter back. I want $255,000. I counter back. I want $250,000. You know, that's how that goes. You know what I'm saying? And then whatever you decide, because you always want to leave room for whatever needs to be done. But the housing market, it's really for buyers. It's picking up. The housing market is picking up, and it seems like I'm jumping around. The days on market, you know, like I told you before, if the house is sitting on, and that's one of the things you want to look at too when you're working with an agent. You want to ask the agent, how long has this house been sitting on the market? Because there could be a reason why it's sitting on the market. But then also too, right now, I had just showed a house a couple weeks ago. The seller is motivated, but here's the thing. My buyers are still talking about if they want the house. And that's another thing. If they're motivated, then they will take pretty much dang near any, I ain't going to say dang near anything, but whatever offer you give them, just depending on how motivated they are. You know what I'm saying? The house may be listed at $300,000. You come in at $260,000, he may take it because, hey, he's motivated. He's trying to get rid of it because he's trying to go somewhere else. You know, any other questions?
Yes. Let's talk about programs.
Okay.
For
all
buyers.
Right. For buyers.
So single families. Let's start with something.
Well, that is gonna tie in.
Okay.
So keep in mind, I am not a lender.
Okay.
So there's certain things that I'm gonna speak on, and there's certain things that I'm not gonna say.
Okay.
Because I am not a lender.
Right.
But you have, of course, your FHA homes, and then you have your USDA, of course, VA, and then a conventional. So those are your four loans.
Okay. Can you explain?
Yes.
Okay. That's
so your conventional loans are from per my lender that I talk to, and again, these are for people that are just like it's like a traditional loan. Like these are the conventional is the higher loan where you putting down 20%, 20%. Or whatever. I mean, some it could be lower, but conventionals are basically for people with higher credit scores, maybe, and the higher down payments.
Okay.
Your FHA loans are people that has a credit score of a 650, and their down payment it usually require like 3.5%. So that's not bad. VA loans are for veterans only, and they. I think it's like no percentage down on that one. Again, I'm not proficient in that, but and then you have your USDA loans. It's also 0%. And then what that means is that with USDA loans, that just can't be in the city limits. Like you can't be in the city. You have to be in the rural areas. Rural areas and everything. And the programs that they do have down payment assistance programs, which is $15,000 down payment assistance, but you have to qualify for that. You have to qualify for that, and that usually run neck and neck with FHA.
Okay.
Per my lender.
So FHA, you were saying your credit score got to be a certain.
I think she said 640, 650 for the FHA.
So it's got to be kind of low. It can't be 700.
I mean, no, it can be.
Okay.
Yeah.
I didn't know. Because there's a lot of different things out here for different folks.
Right.
Like,
exactly.
You make too much, or your credit score too high.
Exactly.
So that's what I'm asking. Just for people out there to know.
So that's the lowest.
Okay.
And that's my fault because I should have explained that.
No, you okay.
That's the lowest that if you have a 650, I think 640, 650, you can qualify for an FHA loan. Okay. But again, that is still going to depend on the lender. You know what I'm saying? Just know that when I tell you this, you still want to always talk to your lender. Okay. Like with the conventional, like I said, that's higher credit scores. You know what I'm saying? We're talking about people in the 7s and close to the 8s and the people that can put down that 20%, you know what I'm saying, of the purchase price. Okay. So whatever. And USDA loans and VA, don't really talk about that because I haven't worked with any buyers as far as VAs and USDAs, but mostly, I have buyers come to me wanting to get qualified for the FHA, but again, I can't qualify them. I have to send them to a lender, and everything. So that's how that works in the down payment assistance program. I think that just actually went into effect as of last year, year before last, but this is how this works. So if you're one of those ones that you have to have reserves. And reserves means savings. You have to have a savings whenever you get ready to purchase a home. And like I tell everybody, I'm just a real estate agent. I just help you find your house. Once you get, once I help you find the house, you know what I'm saying? Then the lender, this is after the pre-approval, because I don't take people to go look for a home until they are pre-approved, because we need to know what price range you need to be in when you're looking for a home. So what I normally tell people is that, I send them to a lender. They come back to me. I tell people that the lender's running the show throughout the whole process, because they are the one that's giving you the money. They are the ones that's going to make sure the house is going to appraise. Once the house that you pick, they're going to be the ones to make sure that it appraised for however much they're asking for. And if it don't, then you're going to have to move to something else. So I had this one buyer that reached out to me. She knew nothing about buying a home. First time home buyers. And that's fine. That's cool. But I told her, what I'm telling you is what I told her, I'm just a real estate agent. I help you find a home. Once you find the home, we make an offer. Offer's accepted. You know what I'm saying? Then we do due diligence. And then my job on the due diligence part is to make sure to find the best, home inspector for you, so that, that way you can find out what's going on with the property. And then if you like it, if everything comes back okay, then now the lender is going to send an appraisal, because now the lender is going to want to know if this house is worth the money that they're asking for, because they're funny about their money, honey. I'm just going to tell you.
And they should be.
They're funny about their money, and they're not going to, if it's not going to appraise, they're not going to lend. I mean, that's just, so. And but those are your 4 different products. You got the conventional, you have FHA, USDA, and then VA. You have those, but a lot of people is going after the FHA because FHA has a lower percentage rate, 3.5% of money put down.
That's
now,
great.
3.5% of money put down, whereas conventional, it usually run like 20%. And that's a lot of money. Like if you're purchasing a $300,000 house, you take 20% times that. That's how much you're going to have down. That's a lot of money. But most of us don't have that kind of money, so
right.
If that makes sense,
right. So I'm going to ask you another question. So are there any programs out there like for minorities, you know what I mean? Asian,
that
Black,
part,
Indians, all
that will be a lender's question, because they know about all of the different types of what's out there. And I'm glad that you asked that question too, because there are some questions that I do want to ask some lender that I affiliate, that I deal with. There's some things that I want to ask her, so that would be a good question for me to ask her as well, and get back with you. But that is a great question.
This is very educational, man, and I'm glad that you came through to voice what it is that you know about the industry and what it is that we should know about the industry, right?
Exactly.
So, I think it's just something else that you want to.
I do. I am planning on having a home buyer seminar soon. I would love for you guys to come out and just kind of get educated on it. I haven't set the date yet. I'm still working some kinks out. But I am thinking about having a home buyer seminar, and I'm trying to figure out the place that I want to have it at, which I think I know where I want to have it at. But I want you guys to come out, and I'm going to try to have a lender there. Definitely, I will have a lender there. And then I definitely want a home inspection there. And I want these people there because they can actually get in depth.
Right.
With what they do. If you have questions about, as he just did, about the loans, the different types of loans, the lender would be, great to be there to answer those questions, because she can get more depth in it, because that's his or her lane of field. Right. With the home inspection, same way. He can do the same exact thing. He can get in depth on telling you what he looks for, what he expects, this and that and the third. So that's as soon as I get this together, get all my, because I'm kind of battling with the insurance stuff too, but as soon as I get this together, I will definitely reach out to you.
That's great.
And everything. And to the people, because if y'all know me, I do a lot of posting on Facebook.
That's great. That's good. So that's how I see what you still doing what you're doing. Yeah. All right. That was good. I wish I had more, you know what I mean? Because I'm what you call illiterate to the housing Even though I'm ready to start buying, I want to start buying to be able to either flip or rent.
Yeah, so you're on the investor side.
We
need to
talk
sit
about
down
that.
and talk.
We definitely going to talk. But now we're going to jump into the most important thing outside of being able to have somewhere to rest your head at.
Yeah.
Is your health.
Yeah.
Right. Now let's go ahead and start with what got you into medical insurance or what it is you do that deals with it.
So medical insurance, I'm not, but life.
Life.
Okay, so you're fine. I wanted something else to kind of tie along with the real estate. And I forgot to say this, that I became interested in both because of my male friend that I deal with. So he's big on all this stuff, and so that's how I became interested in it. So I just want to kind of point that out there.
That's good.
But I wanted something to tie along with the real estate, with the housing. I wanted something to offer my buyers in the event that they purchase a home. So we're going to talk about insurance, and we're going to talk about, I was already working on getting my insurance license before my dad died or whatever. But the reason that I got involved in it, again, it was because I wanted something to have to offer my buyers whenever they purchase their home. So the insurance side of it, as I mentioned before, is very, 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 I'm not going to say the word crucial. It's better. It's you need it. We need it. If you can insure your vehicle, if you can insure your home, why not insure your life? And this is what I think about this every night. I'm like, okay, so when we talk about insuring our lives, I don't have that kind of money. I can't do this. But you're paying insurance for your vehicle that something can cause you to have that you can die in. You paying your mortgage insurance where it can catch on fire. Anything can happen that could end your life. Your house and your vehicles are insured, but you're not. So here's the thing with insurance. Now, what do you want me to talk about? The products or just,
I want you to talk about all of it.
Okay.
I'm learning. I want to know.
So the insurance, I deal with 4 different products. Term, final expense, whole life, and IUL. And then annuities is something different. I'm still getting myself on annuities and learning about annuities. So I'm not going to talk about that just yet. But if you want to bring me back and just talk about annuities, we can do that. But we're going to talk about term, final expense, whole life.
Oh, we recording? Hi guys, this is Mr. Stay Fresh on Have to Get Fresh, host of the H.U.S.H podcast, Run, asking everyone, please like, subscribe, and share it to all our major platforms. It'd be truly appreciated. Thanks.
And IULs. Okay, so your term policies. And I want you guys to keep in mind that I hear a lot of people say this. I can't get insurance because it's too expensive. Okay, so how old are you? When you come to me at the age of 40, your insurance is going to be ridiculous. Keep in mind that insurance plays on 2 factors, age and death benefit. 2 factors, age and death benefit. So if you have a 18-year-old that comes to me and needs a term policy, now term is supposed to be cheaper, but it doesn't matter because if you're 40 and up, you're not going to pay that cheaper rate because again, it plays on age and death benefit. So if I have a 18-year-old that comes up to me and say, hey, I'm looking for some life insurance, but I just want pure insurance. He's not looking at cash value. He just want to protect himself for a specific period of time. So what that means is that I'm going to run a quote on him. He's going to get this insurance, maybe a $250,000 policy for about $16 a month or $20 a month. But here's the thing. The thing with term insurance is cheap. Insurance only. No cash value, build up anything, but it runs out. It's not guaranteed. It's for a specific period of time. 5, 10, 20, 30. So if you get a 5-year term or a 10-year term, if you outlive those terms, you 5 years older, if you decide to renew it, it's going to be higher. Same with the 10-year term.
Okay.
If you decide to if it runs out, you have no coverage. Now you have to renew. Now it's more expensive.
So before we go on, why would somebody want to pick this term over any of the others?
Because it's affordable. It's affordable, and your younger people who's starting a family, they can get X amount of dollars death benefit. They can get $1 million death benefit,
right,
for a little nothing,
right,
to protect their family. But here's the thing.
Yes.
Here's the thing. If you outlive it, you're not covered.
That's why I was like asking the question, why would you know what I mean? So
but,
you got to take to me, I feel like everybody that thinks about life insurance, that will be one that you want to cut off, because expect that you're going to live longer than what, you know what I mean?
Yep.
That's the only reason. But go ahead, I'm going to let you go.
But if you die within the term, then of course whoever your beneficiary is, they will be paid the beneficiary. Keep in mind, y'all, life insurance death benefits are tax free. Keep that in mind. So if you get a beneficiary, if you are somebody's beneficiary, you're not going to know that until the time that they pass away. It is tax free. But here's the thing. Another reason why younger people get term life insurance is because of the mortgage protection side. So let me explain this to you.
Okay.
When I told you that I wanted to tie this in with my real estate,
right,
my first time home buyers, okay, they purchased a $250,000 home. Now the mortgage companies are going to try to get you to get their mortgage protection for, to protect your home. But what you fail to realize, and what they fail to realize, is that the mortgage company is the beneficiary. See, if something was to happen,
they pay the house off.
They pay the house off. Whatever's left, they're gonna take it back.
Yeah. And that's how they continue to get rich too.
Yeah.
Okay, so and that's why they say that we should all, and that's not to cut you off, but I gotta let people, I gotta do this for this part of the podcast. I'm sorry.
No, you're fine. No.
So one of the main things that they say, because in the black community, there's not a lot of life insurance policies, which by far is not making no sense, because if we talk about generational wealth, she just explained to you exactly how all companies that offer some kind of insurance do us. You know what I mean? Get our insurance, so if something ever happened, we'll take care of this, and it might be $100,000 and $200,000 left on a policy that they get to keep. Yep. So just imagine helping your next generation of people out with it. So I just want you to throw that out there, why it's important to have it, besides being able to be buried. You know what I mean?
Exactly.
But go ahead.
Exactly. But if you use a term policy,
okay.
I just did a presentation on this.
All right.
If you do a term policy, then what they want you to do is, if you have a $250,000 policy, $250,000 mortgage, get a $300,000 term policy. So in the event something happens to you, your house will be paid off, and your loved ones will be taken care of. All your expenses will be, and then I'm just using that as a number.
I understand though. It makes sense.
It makes sense.
Right.
And it's a lot cheaper.
Yes.
So that when you ask that question, why do people do that? Because they can actually pay off their mortgage. You know what I'm saying? But you got to remember too, you got a 20-year term and you got a 30-year term. So if you got a 20-year-old that's got a 30-year term, they're good. They're good. I don't see. Well, I'm not gonna say, because we never know what God has in store for us. But they're pretty good or whatever. If something was to happen to them, they can actually get their mortgage paid off. So, but with the term policy, it's less expensive depending on your age. Now, we're talking 40, 50, 60-year-olds. You're not finna get the cutoff point, I believe, is 75 for a term policy. If you're over the age of 75, you're not going to get covered. You are a liability. You are a liability. But just keep in mind, the older you are, the more expensive it is. And the higher the death benefit, it's going to also associate with that price. So you 50 years old, you want a $250,000 policy, you're going to probably be paying about $150 to $160 a month, depending on the carrier.
Which it still ain't bad.
That's not bad, but
because you still the long run. You know that you got
exactly
things taken care of.
Exactly. And term policies, again, is set for a specific period of time.
Mm-hmm.
It does not last your whole life. It is for a specific period, 10, 20, 30. 10, 20, 30 years. That's it. But a lot of people like it because it's cheap, it's affordable if they get in at a younger age.
Mm-hmm.
And we still do have older people that wants it because, they can't get whole life because whole life is going to be way expensive.
Okay,
We'll talk about that too.
Okay, yeah, let's go ahead and
Final expense. We'll talk about final expense next. Okay, so you were talking about the black community, right?
Mm-hmm.
Do you know when I got into this business, believe it or not, it is a lot of black people that get final expenses.
Okay.
Final expenses.
What is final expenses?
Final expense is what it is. Final expense. It is a whole life policy.
All right.
That builds cash value, but it's not aggressive. So pretty much these policies ranges from $100,000 to, depending on the carrier that I was with was $35,000 was the most that you can get. There's some that I've seen that's $50,000. It just depends on the carrier. But we're gonna talk about I can't mention the name, but the carrier that I was with from $1,000 to $35,000. And again, I'm gonna always say this throughout. Age plays a factor.
Mm-hmm.
Age and death benefit. So there's a lot of people in our community that has final expense insurance because it is affordable. It is a whole life policy and it is affordable. It's very affordable.
Mm-hmm.
But my thing is that, well, I forgot what I was going to say. My thing is that, a lot of them that get the final expense are our elderly people.
Mm-hmm.
Or our elderly, they probably like 60. 50 something to 60 something that they get. And these policies only be like for them, just depending on how they can pay for it, be like $5,000.
So it is exactly what the name of it
is. Final expense.
Yeah.
Final expense.
That's just going to bury you.
Your average cost of funeral.
Mm-hmm.
Your average cost of funeral is between $7,000 and $12,000.
Mm-hmm.
That is your average cost of funeral.
Mm-hmm.
My daddy's funeral was $10,365. That's your average cost of funeral.
Mm-hmm.
So final expense, some people just get it to just have. Some people maybe cremate. Cremation even done went up.
Sure have.
That used to be what, $800, maybe $750.
Mm-hmm.
That done went up,
Mm-hmm.
depending on which company you use.
Mm-hmm.
You know what I'm saying? So you're exactly right. If final expense is exactly what it says, it pays the final expenses.
Mm-hmm.
Is what it does.
Mm-hmm.
And so can't really and with final expense, it's easy. Well, and with term, and I forgot to tell you this term, some of it, depending on the carriers, there's no medical exams whenever you go to do this. But like I said, depending on the carrier. Final expense, the company that I was with, no medical exams. It was just simple, maybe 10, 12 questions that you answer. And what they only check for is prescriptions to see if you was on any prescriptions that would disqualify you to get the final expense side. And if something came back on your prescription check, it didn't disqualify you from getting insurance. It delayed it. Mm. It threw you into a modified category, meaning that 2 years, you can still take out insurance, but it wouldn't go in effect into 2 years, if that makes sense. So, yeah. So.
What's your other one? Your next one?
Whole life.
Okay, I got a question. Now, is it that whole life at a certain amount of time you can borrow off of?
Yeah.
And you don't have to pay it back. They just come off the whatever your...
It depends on the company.
Okay, well, let's listen.
Okay, so whole life insurance, it builds cash value. It's expensive. It is expensive.
Mm-hmm.
It's guaranteed insurance throughout your whole life. That's why it says whole life. Mm-hmm. Premiums are set at a fixed rate. Whatever you get in that is what you're going to pay until the day you die. Mm-hmm. Okay? Mm-hmm. Cash value, it grows. Mm-hmm. It grows just like the final expense, but it's just a little bit more aggressive than final expense, but it ain't as aggressive. Okay. So you can borrow off of it. You can, but it just depends on the carriers. You know what I'm saying? Of how it's going to affect the death benefit, things of that matter. But final expense is, whole life is expensive because, again, it's guaranteed life insurance. Again, it's going to pay off your age, paying off your age and the death benefit again. But here's the thing. It's a it's guaranteed. So that means that I just ran a quote for a guy who's 65, which I already knew that it was going to be ridiculous, but I did it just because, he wanted to see what the numbers was. 65 for a whole life policy. Do you know how much this man was going to pay for a $100,000 policy?
How much?
It was $494 monthly premiums. God. So I reduced it, the face amount to 50 grand, and it was half that amount.
Yeah.
A 20-year-old, I did a quote on a 20-year-old. I'm always, if you go to my YouTube page, you'll see it. I'm always doing quotes showing the difference. I did a quote for a 20-year-old on a $100,000 policy. That 20-year-old, it was like $150 a month, which is not bad. But this is for a $100,000 policy, I think. And then, but the more I went up on the face amount, the higher it got.
Yeah.
So, I mean, it's expensive. It's very expensive. But the good thing about term that I forgot to mention is that you can convert that over into whole life during that term. So if you have a 20-year term and you 5 years into it, you be like, okay, I'm ready to get me a whole life policy. You can convert that over. Now, mind you, the price is going to change, but it might not be that different. But the price is going to change from, I'm going to say $50 to probably like $100, if that, you know what I'm saying? But you can convert the term life insurance over into a whole life. But just know that whole life, you can borrow from it, but it's going to be dependent on the carriers. And I don't really like kind of getting into that part of it. You know what I'm saying? Because not unless I'm with that carrier, I don't get too specific in it, but I will sit down with the carriers that I'm with, and we can sit and talk about, they do let you borrow off the carriers that I'm with and everything, but I don't think that it has to be, as long as the policy is in force, you don't have to pay it back. As long as you pay it, making your monthly premiums, you're good to go. But if you stop making your premiums, then of course you're going to be due that money. They're going to be due their money or whatever, so. And it just depends on the carrier. So that's whole life that I got from. So just keep in mind, y'all, that it doesn't matter what the face amount is. Face amount and age plays a factor in this insurance game. So if you are one of those ones that's looking for insurance, please, I tell everybody, I talk to my niece, I talk to my nephew, hey, you need to be trying to get covered at a young age because the older you get, the more expensive it is.
Right.
That's the whole life side of it. So now we're going to talk about Index Universal Life, IUL.
All right.
Now this product been around for a minute. I'm talking about the old people that don't look like us has been playing this game for a minute.
True.
So this is also a whole life policy, but it's better.
Okay. Index
Universal Life Insurance is a life insurance policy where, you know how we used to say, oh, that's all people want to think about is dead people. Life insurance is for dead people. No, sir. Index Universal Life is also, it has living benefits as well. Okay, so we're going to talk about maximizing your IUL, and then we're just going to talk about straight life insurance for the IUL. So a lot of investors do this. So Index Universal Life, it is not actually tied to the stock market. Have you heard of S&P 500?
Yes, I have.
Okay, so there's other indices out there that plays off of the IUL, but S&P 500 I'm familiar with, and that's the companies the company that I'm with, they use that.
Okay.
So what this means is that when you purchase, and you still have to qualify for this, you still have to take a medical exam for whole life and the IUL, and it's going to factor off of whether or not you get approved for the life insurance, because it's still at the end of the day a life insurance policy. Okay. So what this is that I'm just going to kind of briefly go through this. It is a insurance policy that performs off of the S&P 500, the stock market. It doesn't, it's not tied in with the stock market. It performs off of the stock market. What that means is that you have a cap and you have a floor. Some insurance companies may have, just say like the insurance company I'm with, I'm just going to make up a number. They have a 12 or 13% cap. Well, the stock market just jumped up to 16%, okay? So now, with that being said, you just got your 13% credit for that.
Oh, so you So you gain from it.
You gain from it. And then when the stock market drops, your money is saved. So a lot of people play this game because investors, what they do is, again, you have to qualify for it. You have to qualify for it. You qualify for it. You pick, and the death benefit for the maximum cash value, the minimum death benefit max cash value, is that they're not caring about the death benefit. It's a minimum death, but they don't care about that.
Right.
They're trying to maximize their cash value because they got stuff that they got to do. They're trying to invest. They're trying to do this, whatever it is. And so what they're going to do is they're going to put like so much money in there a month. Now, keep in mind with Index Universal Life, you got to be careful how you fund it. Okay, you got to be careful how you put the money in there because they got this thing where it's called a 7-pay test. If you put too much in, like it tells you on the illustration how much you can max it to within that year. You cannot, if it's like a $10,000 match, I'm just making up numbers. If you go over that, now you're subject to IRS getting in your business. So you got to be careful how you do it. So if you're funding this, if you're putting in your monthly premiums, and just say like you putting $2,000 a month in there, you making your monthly premiums. By the end of the year, 2,000 times 12 is how much? It's
24.
Yeah. So you got to be careful if it's like at 25, you don't want to go over that. You know what I'm saying? But the more money that you put into this IUL, the faster the cash value is going to grow. It's going to build up. So if you're funding this $2,000, $3,000, however much money you want to fund it, you're not really caring about the death benefit because at the end of the day, you're trying to get your cash value up to where you can get whatever you need to get or whatever, do whatever you need to do, blah, blah, blah. You know what I'm saying? So that's how that works.
So could you just put 150, 200?
Huh?
Could you put 150, 200?
152. Okay, wait a minute.
Could you put 150, 200?
Oh yeah,
400?
It don't have to be in the thousands.
Okay, yeah. Because there's people out there like I can't even afford that.
No. I was looking to that. Yeah. Okay, go ahead. So yeah, you can put 100 to 200. It just depends on how the illustration is. You know, when I run the illustration, it'll let me know, what you can put in, and that's the thing about it. It's flexible. It's flexible because just say like, you started funding it with $500 monthly, right? And then something came up and you can't no longer pay that $500. You can reduce it down to $100. So yeah, to answer your question, yeah, you can fund it for $100 to $200. You can do that.
Okay.
It's flexible, you know. But what I was basically, and I'm so sorry, I should have kind of explained myself. I was basically focusing on the investors because there's a lot of investors use this, and then they have this. But yeah, for my people out there that don't, that's just like me. If I get one, and I will get one, I don't have one yet, But when I get one, I'm gonna start out gradually. I'm gonna start out 150.
That's right. That's why I asked that.
Yeah, you can do that. And then if you feel like if you start seeing work picking up or your business picking up, hey, I'm gonna put a little bit more extra into my IUL. And here's the thing: most insurance agents or specialists, they need to sit down with their clients once a year to see where they are at. Because every year things change. Right. We need to have an evaluation with them once a year to see, hey, are you able to go up on your monthly premiums?
Right.
Or do you need to come down on your monthly? What has changed within the last year of us writing this policy for you?
That makes sense.
And so that's the things that, I don't want to just sell insurance just to sell it and get money. I want to make sure that I want to check on my clients once a year or every 6 months, however it is, and to see where they at. And so I can tell you a little bit more about, if you want to have a consultation with me, you feel free to call me at 828-7894. 794-8111. Y'all, I am losing it. But 828-794-8111. You can also email me at Natashia, that's Natashia, at lakeviewinsuranceco.com. And also with real estate, if you want to talk about real estate, because I have two different things that I work off of. I keep insurance and real estate separate just so that I can keep up with things. That's the same phone number, different email, which will be Natashia, Natashia.Johnson@exprealty.com if you're wanting the real estate side of it, you know. So I definitely want to talk to you guys about the annuities, but I'm just now getting into that, you know what I'm saying, learning into that. That's going to be my next big product that I talk about. But that IUL product for my people, and it's good for babies. It's good for children. And let me talk about that for a minute. Because if you are one of those parents that is wanting to see your child, not everybody go to college, but there's a lot of us, people like me and you, who wants to go to college, but they just don't have the funding. This is a way to do it. You can start a IUL policy for your baby, and by the time your baby hits 18 years old, ready to go, the cash value will be massive. It will be in there if you don't touch it.
Right.
So this is a way, if they want to go to college, that's good. If they don't want to go to college, but they want their first car, that's good. Whatever the case may be. And I also want to tell you, with all the products that I offer, certain companies will offer the critical illness, the Alzheimer's, the there's more. I can't think of my. They call them ABRs.
Okay.
And that's for the long-term, not long-term care, but the Alzheimer's, the critical illness, you know, things of that sort. That if something was to happen and you become critical ill, they'll pay you for it.
Okay. That makes sense. That's a good insurance to have too.
Yeah.
You know. Okay. All right.
So yeah, I hope I answered your questions and stuff, like, you know, because sometimes I get talking and.
Well, I'm trying to tell you, man. I'm in literature. This person might have been quiet like this in here.
Yeah,
you know
but it's a lot.
But I like the fact I like to learn.
Yeah,
you know what I mean?
And I can tell, I can see that in you.
I like to learn. But I want you to give everybody your contact information one more time.
Okay, so for life insurance, if you're looking for life insurance only, it's Natashia, Natashia at LakeviewInsuranceCO.com. My phone number is 828-794-8111, and that will also be the same for real estate, the phone number wise. If you're looking for real estate and you want to, you know, sit down and we consultate about anything, you have questions, that's also for insurance too. My real estate email address is Natashia, Natashia.Johnson@exprealty.com, and the phone number again is 828-794-8111. So just reach out to me, and I'm always happy to help.
Well, you guys, I mean, I try my best to bring out information to you all that we all can use, that we all can be a part of, man. Please don't hesitate, man, to reach out, talk to a man about insurance, and most importantly, your health insurance, your life insurance. If you don't, that's on you. That's all I can say about it. But for those of you out there that's interested in buying a home or some rental properties to turn over or whatnot, please reach out to her. You know, like I said, she know what she's talking about and what she's doing. You heard her. You know what I mean? You all learning just like I'm learning. Let's go ahead and continue to do that, man. Stick together, work together. Let's get this done.
So I want to also give a shout out to my guy friend that actually got me turned on to all of this. And then I want to give a shout out to my BLA partners. Thank you guys for accepting me. And I'm just so glad to be in this industry.
But there you go. Oh, we recording? Hi guys, this is Mr. Stay Fresh, so I don't have to get fresh. Host of the H.U.S.H podcast, Ron, asking everyone, please like, subscribe, and share it to all our major platforms. It'd be truly appreciated. Thanks.